Well, hello and good afternoon, everyone. Happy New Year and welcome to Bull Prime's webinar. Alex, I'm your host today, and we have a guest speaker to share on the common mistakes that traders make and how we can avoid them. We hope you find today's session informative and insightful. Just a few notes before we begin. So the sharing session will last for approximately 40 to 45 minutes. And after the sharing, we will make time for Q&A. So feel free to ask questions throughout this session on the Q&A part at the bottom of your screen. So I repeat again, feel free to ask questions throughout the session on the Q&A part at the bottom of your screen. Also, on another note, we are running a 365 bonus mania where you stand a chance to receive a 30% bonus from your deposit account. So be sure to claim it before it's too late. And on behalf of Bull Prime, there will be more surprises for you in the next few hours. But let's get back to our session and allow me to introduce you to our speaker, who is no stranger to us. So he was featured on Singapore's Channels News Asia for gaining 30,000 with just $500 in 2 years. He has won awards such as Most Popular FX Trainer in Asia Pacific and Top Forex Analyst by WikiFX. Now his goal is to help people like you and me and others to achieve financial mastery by empowering people to design the life that they want. So let me present to you Mr. Ang Kar Yong. So over to you, Kar Yong.
Hello, good afternoon, everyone. Thanks again for having me in today's session over here to be sharing about mistakes and some solutions and suggestions on how to avoid them, right? I think this topic itself is going to be very, very important for all traders. Doesn't matter if you are new or you have some experience in the market. It's generally a good reminder as well. Like a lot of times traders are too focused on, the shiny object, which what we call keys and techniques. Whereas they kind of like mislook the importance aspects such as the discipline, the risk management aspect and things like that, right? So today the focus is very much on, talking beyond just the strategy and the methodology, but it's something that it's not, commonly discussed in the public as well. Of course, as we go through today's session, if you have any questions, okay, or if let's say certain aspects, or presentation over here, you have, something you like to explore deeper, do put it up into the chat so that I'll be able to take a look at them, and of course we can further the discussion from there. Okay. So yeah, very, very quickly about myself. I've started my journey in 2012, right? And to date, it's kind of almost like 12, 13 years, depending on how specific, you can count that. And I personally come across many different methods and strategies, right? And I can honestly tell you, it doesn't matter what technique or strategies you use, they can be profitable. Okay. At the end of the day, trading is beyond the strategy is beyond the methods, right? It's something that need to integrate with your personality, with what comes as well as an individual. So the conversation today we're gonna have, it's also, kind of an aspect of understanding yourself, understanding some of the common pitfalls, right? So you can avoid them. Hopefully you gain some insights and help session can help you to improve your trading performance. Okay. So with that said, today we're going to talk about the seven aspect, we'll say the most important statistics, that traders tends to mislook. Whether this mistake sometimes it's I would say like unintentionally, you make those mistakes, or some words, you are not even aware about it. Okay. And some of these mistakes can cause a lot, right? It can cause you maybe losing an entire account, or sometimes, mistakes like this can just cause you to make less. And of course, making less means it's a little bit more difficult to kind of cover up in terms of your losses, right? So things like that, little tweaks like that, would actually make a difference if you kind of compound them. Okay. So let's talk about the first mistakes that many traders would encounter, okay? And that's over trading. Okay. So what's over trading? Is basically when tend to take a lot more trades than you should. Okay. And of course, this can be a little bit subjective, right? Like, how do you really define taking more trades? Okay. So to me, over trading encompasses like if today you experience the 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 thought process, or you kind of like initially you're looking at, for example, hourly time frame. Okay. And then you decide that, oh, there's nothing much here on the hourly time frame. Let's go to the 15 minute, let's go down to the 5 minutes to see if there's anything that I can actually take. Okay. Um, that leads to over trading naturally, right? Because you're literally not following your plan anymore. Okay. The other situation that can really lead you to over trading is revenge trading, okay, where you maybe take a couple of losses, one or two trades of losses, and then um you're in the mindset of, oh, I want to very, very quickly recover those losses and even, potentially make back, right? And then you try to force trades in, like, and then you go into the same situation where um, you're finding it very hard to look for opportunities. You scramble around, along different asset. You go at multiple different time frames just to look for trades, right? Um, this kind of things is, if you're lucky, you're gonna, make some money out of it, profits, cover some losses and things like that. But over the long run, it's not gonna be helpful. Okay. And I've encountered many traders actually doing this without being aware. Okay. So the process of the first step is always about understanding what are some of the possible mistakes here and then being aware of it, right? So that self-awareness level is very, very important. And once you're being aware, and it's actually slightly easier for you to prevent it, okay? Or if you realize that you are kind of doing it quite frequently, then something that you find ways to to. So, what are some suggestions over here? Okay. For over trading, obviously, one of the easiest way to kind of have that discipline, is really to have what we call a trading plan, right? And to be very honest, a lot of traders may not have, okay, a proper trading plan. Okay. Uh, a lot of times when I ask traders, right? They come to me and then they say, "Oh, I find out a little bit more in terms of how I can improve and things like that." And then when I ask, "Do you have a trading plan that you're being very clear how you're gonna approach the markets and things like that?" General kind of like strategy, but often than not, traders do not have a proper trading plan, right? A lot of times, trading plan is actually beyond just like entry and exit criteria. Yeah, I mean that's the basic stuff, right? That's like the baseline. You need to have your entry and exit criteria. A trading plan actually expands beyond that, right? It also covers what are the aspects. Okay, are you just gonna look at major currency? You're gonna look at commodities? Are you gonna look at okay? What are the time frame of the charts that you're gonna look at? Okay, those are the things you need to have inside. What are the time that you're going to be analyzing the charts, right? What are the days you're going to be actively trading? Okay. So all these details needs a trading plan. Okay. Like for me, right? I'm just going to share you like what I do on a regular basis. So on my trading morning, I'm going to look at the charts. I have a well-defined list of instruments that I look into only, right? And what this means is that I'm going to be focused on those instruments that I've selected. And the time I'm looking at is purely on the H4 for my analysis, and then my execution is on the H1, right? So when I have something like this, I don't deviate, right? Day I come in, there's really nothing much. There's no trade setups that I can take on the hourly. Then there's nothing. Okay, I wouldn't go into like the 30-minute, I wouldn't go into the 50-minute, nothing, that because that's not part of my and then again, same thing, right? In the list instruments that there's nothing there, I don't jump into other things. So a proper trading plan sets the boundary for yourself and it helps you to be more disciplined. Okay. That's something that you want to be aware of. Okay. And over trading is also something that might I would say a misconception in trading that often leads to over trading is think trades you take, the more profits you're gonna be, or the common misconception is the lower the time frame you're gonna go, the more trades you're gonna take, the more profitable you're gonna be. Okay, that's not entirely true. Okay, because at the end of the day, it's not about quantity, it's about quality. Okay, I'm gonna give you maybe some very very simple stats. Okay, yeah, good. Now, um, today, for example, right, if your hit rate, right, winning meaning your win rate itself, let's just say it's 60%, right, which is not too bad. And then let's just say your risk to reward ratio, we keep it very, very simple. 1:2, okay, which means that if today you take a trade, you risk 1%, and then if that trade wins, you win 2%, right? In fact, if today we just take a 1:1 risk to reward ratio, if you risk $100, you're gonna make $100. With a 60% win rate, this system is profitable. Okay, just by math, it's a profitable system. And then a lot of traders would then think, all right, if I go down to the lower time frame, I'm gonna make more money, right? I'm gonna take more trades, I'm gonna make more money. The answer of that is not entirely true because statistics works. Today, if you go down to let's say a M15 and you decide to take 100 trades, right? Because it's a smaller time frame over a period of time versus someone who is looking at maybe the hourly chart and then, it probably only take about 20 trades over the same period of time, right? Because of a larger time frame. Does it necessarily mean that you're going to make more because you take 100 trades? No, right? Because why? Statistically speaking, your win rate is likely going to be the same. Okay, out of this 100 trades, you're going to win 60, you're going to lose 40. Okay, my Zoom just got restarted, but I think everything is fine here. Okay, yeah, my drawing is gone. But what I was saying just now is a 60 losing trades, right, versus a 8 losing trade, right? I'm talking about, sorry, not 60, 40, right? I'm talking about how overcoming that 40 loss takes a way more resilient mindset as compared to handling like 8 losses. Okay, and which one do you think would be prone to making more mistakes, right? Naturally, this side. Okay, so the more trades you take, the more occurrence of losses is going to be happening, the more prone you are in making mistakes, right? And naturally, those mistakes will cost you, right? Whether is it unnecessary losses or kind of like taking bigger losses and things like that. So I just want you to know that quantity doesn't mean that you're going to be more profitable. Okay, that's something I always stress to traders. Okay, don't think that, oh, the more trades you take, the more profitable you're going to be, because basically, the more trades you take, naturally you're going to have more losses as well, and that opens up to mistakes. Okay, now, another thing you want to do is to track okay, is to track your trades. Okay. Now, this is important because today you want to have a certain method to understand and find out like what are the elements you want to be working on to help you improve, right? So journaling is one of the very important aspect, and a lot of times journaling is misunderstood as, oh, I just need to track down where I enter, where I exit, whether is it winning or losing, and then record down the performance, right? Journal is actually more than that, right? Journal is not really tracking just the date, but it's more of like what are your thought process. Okay, that element is the most important aspect of all. Right, what I mean by thought process is, for example, yeah, today you take a trade. Okay, is this trade something that you're very, very comfortable with? Are you something? Is it a trade that you're very confident in, right? Or is it a trade that you kind of have that feeling in terms of like, it's a valid trade, it's a good trade, but not exactly the best trade I'm very confident in, right? You want to track all this down because if you start to realize that, oh, every time you take a trade that is not very confident in, then in an in the you want to avoid those. Okay. So the idea of journaling is not just about where you enter, where you exit. Okay, I mean those are important, but you want to go beyond that. Okay, so things like this is important, right? Not for me itself, I would show you, some of the things I do. Okay, again, depending on which part of your journey you are in trading. Okay, uh, it might be slightly different in terms of like the methods you're gonna approach and things like that, right? But I just want to show you, how I keep track of all my stuff. You can see this is all the way back in 2003. Okay. And then every day when I do a market, I kind of put into a report. Okay. So what this means is that I can always go back, if I take a trade, right? Analysis, I can always go back and compare my notes. Okay. So this is very important, right? Because if today you don't have any of this, you can't do a comparison, you can't really figure out what are some of the areas you can work on and how you can improve. Okay. So that's really about the journaling aspect. Okay. So number one, over trading. Okay, be aware of that. Number two, which ties into trading plan, kind of talked a little bit about that earlier. Okay, today if you don't have a clear plan, it's gonna be worse. Okay, so what's a trading plan? A trading plan is essentially like a business plan. You want to have everything set out clearly, so it helps you to be disciplined. Okay, so it kind of covers your strategy, covers what you're trading, covers your risk aspect. Okay, basically the more detail you put in, the better it is. Okay, so today if you don't have a trading plan, some of the things that you might find yourself doing is jumping from trades, without a clear reasoning. Okay, so it can be like, oh, I can't feel like this will be the good trade, then I'll just take it, right? And then you have no reason, you have no idea why. Okay, it means you don't have a proper plan. Okay, if today you're kind of taking ideas blindly, following traders, that's also equivalent to not having a plan, right? If your friends say, "Oh, buy this," you just buy without understanding why. You don't know why you're buying because your friend just says so. That's also without a plan. Okay, so why again this is important because if you don't have all this, you can't figure out what are the factors that contribute to your winning trade. Okay. So this aspect itself is where I actually devote DSC, right? So DSC is kind of a framework to develop the plan, right? Some of you may have heard of my sharing before talking about DSC. We talk about direction, setup, and context. It's basically a framework to approach the market. It's a framework to help us develop a plan, right? So the first thing is define your direction. Second thing is you need to have a proper setup. Define where you're gonna get in, what are conditions required for you to execute a trade, and then the context of the trade, right? Context of the entire market itself, confluences and things like that. So again, trading plan is very, very important, right? There's a lot of different strategies. At the end of the day, you want to put it down into a plan to understand like what what are the methods you're gonna approach. Okay. So over here, these are some of the things I covered just now, right? Your plan should include, as I mentioned, what are the asset you're gonna be trading? Is it currencies? Is it commodities? Is it a mixture of some of this? What are the time frames you're gonna be looking at? What is your criteria of entering trades? Where are you gonna get out? Where are you gonna get in? Where are you gonna take profits? Okay, risk management as well, like in terms, how much am I gonna risk per trade? Okay, if I'm having a drawdown of certain percentage for the particular day or week, how am I gonna manage it, right? So when I'm talking about all this, right, just bear in mind it's not something that you're gonna set in stone at the very, very start. Okay, it's a work in progress, meaning you need to have at least something of a baseline to start off. And then as you start trading, following your trade plan, you realize that, oh, this is missing. I need to add this, add it. Okay. And then you realize that, hey, there's certain aspect when you're approaching in trading, you realize that, oh, what should I do about this? Okay. Questions like that as you're trading is very, very helpful because it prompts you and it tells you that something is missing in your plan, right? And you need an answer to that. So whenever you figure the answer, that should go into your trading plan, right? So as you progress, your plan should get more and more developed. It should be more and more established in a way that your trading plan should answer almost all of the questions you're gonna have, throughout your trading journey. Okay. So things like what hours are you trading, right? What's your routine? Like just now I briefly mentioned, right? Every moment in the market, I do my analysis. That's that's essentially it, right? So I don't jump in the market on the random hours and then try to squeeze something out of it, right? Because that's not the plan. Right. So of course some of these things here easier said than done. Requires that discipline. Um, but you at least something for yourself to work on. Okay. So trading plan is very, very important. Right. For those who don't have a plan, always good to get it started, right? And of course, if you have any questions, with regards to like, you encounter certain challenges, you're not sure of things, today's session is ready for you to ask as well, right? You can drop your questions into the Q&A. Now, number three, risk management. This is also very, very important, right? And I realized that actually a lot of traders don't fully understand how to set up their position size. Okay. Now they might understand the basics of risk management, right? They might, as long as you don't risk more than what you're comfortable with, that's risk management. Yeah, right. In general, that's true. But there are actually details to go into risk management, right? Uh, so for example, okay, placing random lot sizes, right? Basically means that, oh, you feel like trading one lot, you put one lot, you feel like trading 1.2, without really understanding the positions, really calculating for the optimum position sizes, then that's not the right way to do, right? Risking too much, of course, if today you're trying to revenge trade, you're being greedy, if you risk like 10 to 20%, of course, it's not that it's a wrong thing to do, it's more like, do you fully understand the consequences of that, right? If you do and you can't accept that, then it's fine. Okay. But a lot of times traders risk big without really taking into account the consequences, right? Okay, of course, moving stop loss, that's also some would result in big losses on one and two trades, right? Now, just now I did briefly mention about how traders not fully understanding position sizes, okay, or lot sizes. Okay, I'm pretty sure like some of you are here are also doing this, right? You might say that, all right, what am I gonna do is I'm gonna set up my trades, and every time I take a trade, I might do like maybe one lot, okay, or maybe you would do like 0.1 lot, of course, depending on the capital. But then you would have this part of your trade that you would say, I'm gonna risk 20 pips. Okay. And that's it. Every time I take a trade, I'm gonna put a 20 pip stop, right? Um, to me, this way of setting up your trade is not optimum. Okay, why? Is because today, if you're gonna fix a 20 pip stop every time you take a trade, you're basically not accounting for the market volatility. You're not accounting asset volatility, right? What I mean by that is sometimes the market might move 40 bits, 50 bits very easily. Sometimes the market may be very volatile and it can go like 80 bits on a single day. Okay. So today, if you're not factoring in the market volatility during that period of time when you're taking a trade, and then you're just gonna be fixated and say every time I take a trade, I'm just gonna put the 20 pip stop. Your 20 pip stop when the market is not volatile may be fine, but when the market is very volatile, then it becomes very easily triggered. Okay. So the thing here you want to understand is your stop loss shouldn't be a fixed. It should account for the market volatility. Okay, then the subsequent question traders would have is like, oh, if I'm gonna keep, my stop loss sometimes 20 bips, sometimes 30 bips, sometimes wider, then wouldn't my risk be inconsistent? Not true. Okay. Your risk is gonna be inconsistent if your lot size is gonna be the same every time you take the, and you're not accounting for that. But today, if let's say, okay, let me clean up a little bit. Let's say today you want to put a 20 pip stop loss and you accounted for your lot size and okay, it's 0.1 lot. Okay, to be within your risk tolerance, great. Today, if the market is more volatile and you need to increase your stop loss to 40 pips, do you think you should still be trading 0.1 lot? Absolutely not, right? You need to actually reduce it because of the math here, it should be half. Okay, and if you are adjusting and calculating your stop loss as well as your lot sizes, you realize that this risk here and this risk here is exactly the same. Okay, which means that I'm actually calculating my optimum lot size according to the market condition. Okay, this is important because if today you keep your risk consistent in terms of the percentage of risk, then you keep a factor in your trading constant. It helps you to figure out what are some of the other things that you can improve on. Okay, so this also ensure that every time you lose, doesn't matter the width of the stop loss, doesn't matter market volatility because you've accounted for the lot sizes. Every time you lose, you know you're gonna lose, like let's say for example 1 hour. Okay, 1 hour if you're doing 1%, then that's 1%. If you're taking 2%, then that's 2%. But you know you're gonna keep your risk consistent at a particular R unit. Can follow, yeah? Okay. So this is something very important because just last week, I had a conversation with a trader. This was something that he wasn't even aware about. Okay. So management, calculating of lot sizes, very important. Okay, so how to avoid? Again, these are very, very generic examples, right? I can't go into details. Never risk, too much of your capital. Always have a stop loss and of course your optimum position sizes. Okay, and never revenge trade. I mean, these things here are easier said than done, but just bear in mind, it takes work, right? It's not like, oh, I know about it and then that's it, right? You know about it, you need to put it into practice. It's on third mistakes, right? Fourth, okay, this is what we call emotional trading, okay, or trading psychology, okay. This is important because as strategy methodology is part of trading, but a big chunk of it is you as an individual, okay? And trading psychology plays a big part in that. Okay? The more you are aware about yourself, the easier it is for you to manage your psychology. Now, the most common emotions traders face is fear and greed. Okay, the fear of losses, the fear of missing out, the greed because of profit, okay, the greed because of revenge trading. Okay, and all this here would lead to unnecessary losses or even bigger losses. Now, bear in mind, traders might have the misunderstanding. They say that, oh, trading must be without emotion. Okay. Uh, Obviously, you can't shut off your emotion, right? Emotions are, but what you want to achieve is control emotions, right? Or at least be aware of it and not let your emotions make those decisions in trading. Okay. Um, Classic example of FOMO. Okay. Example of fear of missing out is where traders tend to chase trades. Okay. They see the market move. Okay. Then what will happen is that they afraid that, oh, it has moved, right? They miss out on that, and then they start to just get involved in it, even when the criteria and the conditions are not there. Right? So be aware of all things, right? And then some traders would be afraid that today, if you take a trade, you're gonna lose out, right? Obviously that's part of it, right? It's all about statistics. It's all about probability. Nothing is certain. Okay. So today, if you encounter that kind of situation where you're afraid of taking a trade because that might be a losing one, right? My suggestion, reduce your lot size. Okay. By reducing your lot size, reducing your risk, you actually would reach to a certain point where taking that trade, if it's gonna be a losing trade, it shouldn't matter at all. Okay. So for example, if today you take a smallest size 0.01, okay, and then you take a trade and then you lose that trade. Now let's say you put in 100 pips, stop loss on 0.001. That is a $10 risk, give or take, right? Dollars risk of 100 pips trade is really nothing. Okay, so if today you start to realize that whenever you take trade, you have some sort of a hesitant, you are afraid of losing, reduce your stop loss. Reduce your lot size, right? Because it can hint to you that you're risking a little bit too much, that afraid of losing. Okay. Revenge trading. Okay, revenge trading is something that um all traders would have, right? Especially if you take a loss, you would really love to kind of recover that loss as quickly as possible, right? I mean, this happens to everyone because all of us has emotion, right? But the key thing here is having the discipline, having the awareness to not force a trade in. This again interlays with having a proper trading plan, right? So a lot of the things you realize that one thing build up. Okay. So some solutions here, right? Some suggestions on how you can actually, move forward. Again, have a trading plan, have a proper structure system. Okay. Obviously you need to accept that losing is part of the game, or else you won't be in this industry for long. Okay. Um, Nothing is 100%. I always like to share with traders, if today you have a strategy that can give you a 60% win rate with a healthy risk to reward ratio of at least 1:2, you're good. Okay. Um, Today, if you don't understand about um expectancy, right? A lot of times traders only focus on what we call a win rate. Okay, but the true measurement of profitability is this thing called expectancy. Okay, so what does expectancy account for? It accounts for win rate and it accounts for your RR, risk to reward ratio. Okay, because today you can have a 60% win rate, but if every time you take a trade and your average risk to reward ratio is like, if you lose one. Okay, if you win, you only win 0.5. Then obviously with a 60% win rate, you still lose money, right? Okay. So this is something you want to be aware of. Okay. So for me, minimum risk to reward ratio, always keep it to 1:1. And today, if you start to work on your win rate, if you can achieve 55 to 60% with a 1:1, you are profitable. Okay. It's a positive expectancy. It's a profitable system. Okay. So be aware of that and not just focus on win rate. Okay, I think that's very important. Okay. Of course, if you're into, kind of meditation, right? Kind of gain mindfulness in trading. Okay. That's definitely going to be helpful as well. Okay. So at the end of the day, when we talk about emotions, is really the fear side is actually quite easy to manage. You just need to really reduce your lot size to a certain level where you have no fear in trading. The greed is obviously, right? Okay. Often time greed also cause traders to fall into potential scams. Okay. So bear in mind. Okay. Good. Okay, I do see some questions. I'll take those questions at the end, right? At the end. Okay, number five, right? We just want to touch on some of these mistakes here. Number five is ignoring market conditions. Can I also talk about this, right? When you're adjusting your lot sizes, you want to optimize it because you want to account for market volatility. Okay. And of course, it's also beyond that because every strategy would have its strengths and weaknesses, right? Some strategy are good range environment, some strategy are great for trending environment. You want to understand this as well, okay? Because traders might, pick up a strategy and then when they start to apply it in the market and the market conditions doesn't really fulfill that strategy, and they don't understand this principle, they would say that the strategy doesn't work, right? And then what would essentially result in them doing is they're gonna jump ship, right? Strategy A to B to C, back to A to B to C, and then this cycle will keep repeating itself. Okay, because they don't understand that market conditions are changing all the time. Certain strategies will perform during a certain period of time, and then it's not going to perform as great as it is. Okay. Um, so what you do is you either would have a few strategies to tackle the different market conditions, or you simply accept the fact that, all right, if today the market conditions is not optimum for my strategy, I'm not going to be taking too many trades, right? So you want to be at least aware of this. Then, depending on how you want to solve it or how you want to approach it, there are many ways, right? Like for me, I really trade the trend. I don't really trade range. But my strategy kind of capture the opportunity where the market is showing sign of a U-turn. Okay. So obviously when the market is ranging, not have any setup, right? When the market is trending very strongly, I wouldn't have any setup as well. So you want to be aware of like your strategy does under which condition. No, for example, right? If I tell you today, oh, gold is trending very nicely in a couple of weeks. Would I have a entry? Would I have a setup to be trading gold? No, right? Because I know my strategy not in capitalizing when the market is trending, right? So you want to have that kind of awareness, right? So that's why I want you to be aware too. Okay. So approaches you can do here to understand market condition is of course you need sample sizes. You need to have that uh time spent in the market, right? Meaning you need to really look at the market, you need to flow with the market to understand right now, this asset is in a trend environment, it's in a range environment and things like that. And then of course, as you apply it, you want to be aware like what your strategy strengths are. Okay. Um, so some simple tips as well if you are fairly new in trading, especially if you're doing short-term trading intraday, you want to avoid trading major news, right? At least for new traders, because that's where, to be very honest, a lot of technical analysis will be violated. Fundamentally not necessarily be there. But during this kind of major news releases is sentiment, right? Sentiment is what is going to market. It's often going to be like very, very short-term volatility. Okay. So if you're fairly new to the market, if you're trading intraday, then these are some little tips, at least for beginners. Okay. Number six, this one touches on FOMO, touches on trading trades, chasing trades, right? And oftentimes I see this happen for traders as well, right? They start to see, oh, the price is moving, or even in fact, a news came out, the price is moving, the candle hasn't really closed, they don't have a setup, but then they say, oh, it's moving, let's go in. Okay. Um, I mean, if you have a proper strategy, edge to catch it, so be it, right? But my personal experience here is you never want to catch a move like that because you never know when it's gonna retrace, you never know when it's gonna stop. And naturally, because the market is ready, your stop loss would be wider than you need to have it. Okay. And then that would affect your risk to reward ratio. It's not gonna make a worthwhile trade. Okay. So this is something to be aware. If you start to realize that you own trades because of excitement, you are taking trades when the market is like moving very volatile, and then you start to jump in, often you are actually experiencing FOMO. Okay. So again, some of this suggestion here, you realize they overlap, right? To kind of avoid this, you need to have like structured trading. You need to have a proper trading plan. You need to be very clear of your setup. You need to have that discipline. Okay. Um, and you need to accept the fact that you're gonna miss trade. Okay, 100%, you're gonna miss trades, right? But the good news is that the market is always gonna be there. Okay, the question, how long are you gonna be in the market? Okay. Um, I mean, FX market, currencies market, commodities market has been there, some longer than some of us, right? Um, and I foresee that the market is always gonna. Okay, so when I say how long are you gonna be in the market, it's more like how long can you sustain, you know, um, your interest, your capital in the market, right? Because if today you go big, you go all in, you do trading, you make a lot of stupid mistakes, um, you get burned out, right? And then you exit, right? And that's it. Your journey ends, right? But the market is still going to continue to be there. It's going to continue to function, right? So this whole logic behind it is that if you miss a trade, it's fine. There will always be another opportunity presented because the market is going to be there, right? Um, so don't be afraid of missing out, right? So for example, of years back, Bitcoin was like what, below $100, right? That was like early stage, and then you're thinking, well, if I back then, I bought a couple of units of Bitcoin, today I'll be like retired. Okay. Now, are there traders who successfully done that? For sure. Okay. But does it mean that there's no more opportunities like that in the future? No, right? There will always be, and you don't need to always catch the full trend. Okay. Things like that can be an outlier, right? But don't aim for all this all the time, right? Today, if you're in the market to trade, consistency, aim for sustainability, right? So I think that's very important. Okay. Yeah, I mean, even in equities, right? People talk about Tesla in the past, okay? How they miss Tesla, even Nvidia, right, recently, and things like that. So things like that happen on the market, right? So don't be afraid of missing it. Okay, you have the next chance to make some money out of it. Okay, number seven. Okay, this is where just now I can't cover, right? The importance of trading journal. You need to have it. Okay, in whatever form that you feel best work for you, right? Some traders like to do a vlog, okay, a video format. Some traders like to write. Some traders like to do screenshot. Whatever it is, whatever works for you, do that. Okay. Um, this is important even more so if you're establishing your strategy, right? Because you really want to keep track of what works, what don't, mind that. Okay, so the trading journal is there to really help you do all those things. Okay. Um, you want to keep things simple, right? I mean, strategy, your journal is too complex. It's gonna make things difficult because you need to record this, you need to do that, you need to do this, and then too many things complicate the whole process. You're not gonna do it. Okay, so you want to keep things simple. Um, but what's more important, I kind of talk about it already, is really your thought process. Okay, I mean in terms of like entry price, stop loss price, nowadays platforms like MT4, MT5 does that for you, right? If today you are doing charting on TradingView, you can even do annotation on the charts itself, right? So all those are platforms and features that helped you a lot in doing all this already, right? In the past, um, when I first got started, to be very honest, trading didn't establish. um, I was blogging it, okay? So basically you need a screenshot from NT4 and then you need to blog it to write it down. But today you can even put down notes on view, right? It's really that flexible already. Okay. So utilize all these features to do your trading journal, right? A lot of times people thought that trading journal is like an Excel sheet and things like that. It's actually more than that. Okay. And the emphasis of a trading journal is the thought process behind, right? It's not your entries, not your stop. I mean, that's important, but I think more important is your thought process. Okay. Um, yeah, so I hope that helps, right? Good. I do see quite a good number of questions over here. Okay, I'll be looking at them and start answering them um at the start. Okay. So from the top questions moving down. Okay. Amelia here says my common mistakes entry with no stop loss. Yeah. Okay. I mean, can you have a strategy with no stop loss? Yes and no, right? Again, depending on your experience in the market, depending on how you're gonna manage your account. Okay. But generally, you would want to have a stop loss, right? There are more advanced technique on risk management, like you can do hedging. Okay, you might not have a stop loss, but you might have a hedge position. Okay, if the position goes like against you, you can start hedging it to kind of resolve it and things like that. There are advanced technique that you can achieve. But in short, having a stop loss is one of the simplest way of managing risk. Okay, so that's something to note. Pugo here asks tips of making 500 to become 13,000. Back then is probably I would say a combination of luck as well as a combination of being very aggressive. Okay, because 500 is not a huge sum of money, right? You can afford to be more aggressive, taking a bigger risk with a smaller account size. But if your account is bigger, you probably want to be a little bit more conservative. Okay. Back then, the strategy I was using is purely a trend strategy. Okay, and of course, I did adopt a little bit of a what we call martingale aspect as well. Um, so definitely it's a very, very aggressive approach. Okay, now would I recommend it to everyone? No, right? Um, but that's part of a method, okay, to very aggressively grow a small account to a sizable one. Um, given a few factors that align, right? As I mentioned, there's that market conditions that feel it. Um, I call it a little bit of luck element over there. Um, yeah, so that's how it is. Okay. Psycut here says, I think after all analysis, mental stability important for success, right? Yeah, definitely, right? So I mean, there are different words to that, right? Like mental stability is the one that you mentioned here. Some traders would just call it psychology, discipline. Yeah, okay. It's not just about the analysis, it's not just about the strategy, but it's about you as an individual, how you can use all these things to approach the market, right? Is there a specific training routine or checklist that help reduce mistake? Yes. Okay. So I'm gonna share with you what I do, right? Like for me, okay, I have a framework called DSC, right? Which means that every time I look at a chart, I know exactly what I need to get out of it. Okay, direction, I need to have a way to establish direction. I need to have a setup condition before I get in. The context is basically giving me the confidence or not, right? So this is a framework that I use to approach the market. My routine is basically every morning in the AM, I look at a chart. I'm very clear. I'm going to use a 4-hour chart to analyze. Okay, if I have a setup, if the price comes into a key area, I will drop to a H1 to look for my setup. Okay, of course, my setup with clear criteria, right? I need to see this condition, I need to see that conditions that I can look to take a trade. And then my setup is often a pending limit order, right? Which means I don't need to monitor the market all the time to get involved in it. Okay. And then the rest of the day, essentially, I'm just going to be monitoring whether the setup was triggered. Is the setup still valid? And then I just manage it. That's it. Then the next day repeats itself, right? Uh, so that's how I deal with it. Okay. So you can see it's not very complex, right? But the things that goes behind it is something you need to develop. Okay. Next question I see here is what's the best way to recover from a series of losing trades without losing confidence? Very good question. Reduce your lot size. Okay, reduce your lot size. Um, the thing here is how do you define a series of losing trades as well? Okay, because a lot of times traders would say, oh, if I do two consecutive losses, I'm worried. That's very, very common. Okay. Um, even at times when you take like 4 to 5 consecutive losses, it's not like it wouldn't occur. Okay. So what you want to plan ahead is give yourself at least a buffer of 10 consecutive losses, which means mentally, mathematically, plan your risk management in a way where you can handle a 10 consecutive losses. Okay. And then, of course, by the time you hit like 3 to 5 consecutive losses before you even hit 10, you want to start being a little bit more careful already. Where you want to then start to has the market conditions change? Am I taking losses because I'm making mistakes? Right? These are things you want to start looking into. Okay, and of course, start reducing your lot size. Okay, start reducing your position sizes. To gain back that confidence, to start to see, okay, now I'm getting winnings back, right? Maybe the conditions in the market has shift, right? Now it favors my strategy and things like that. Then you start to gain back, increase back your proper position sizes and things like that. Okay, so that's how I'll approach it. Um, good. I have a problem with overconfident. If I get more profit in this position, how do you have tips about it? Yeah, I mean that's very common as right. You kind of start being a little bit more confident, you start to get greedy. Um, one way to help you protect the profits you have made is to do regular withdrawals, right? If you withdraw out, then you lock in your profits in a way, right? Okay, that's my suggestion. Okay, you can actually withdraw your profits. So in a way, even if you start being overly greedy, uh, you at least already. Okay. Uh, Here another question here. Trend is your friend till the end. Any comment on this? I mean, that's a fact, right? The market either trends up, trends down, or it's just gonna be a range. That's how the market is likely gonna be. Um, so naturally, that statement itself is just telling you, if the trend is up, you have a higher odds of actually winning if you look at buy trades, instead of going counter trend, right? Right. And so, right. I mean, that's like the logical understanding of it. Okay. Yeah, but at the end of the day, it doesn't necessarily mean that you can only trade with the trend, because if today you are contrarian, you're gonna be looking at counter trend and it can still work. Okay, so it's really back to like what your strategy really is. Okay, what type of style of trading you are actually using. Starter traders, what's the best tracking app to avoid making the mistakes in the future? I mean, I don't really use any apps, but I would just suggest, really like you can, for me, I use Notion to track, right? To write things down. It can be a blog, it can be a notebook, it can be whatever you want. Okay. Anything that is convenient for you, I would say, right? Then that works. How can traders differentiate between the temporary market fluctuation and a major trend shift? Any tools or indicators? I would say for this here, you really need to understand market analysis. You need to look at, if today you're looking at technical analysis, then obviously you need to have a way to tell you, oh, the trend is shift, right? I mean, not something over complex, very, very quickly, I just show you one example, if that works. Okay. So for example, I'll just show you dollar index, right? I mean, previously it was coming down. Okay, and then just yesterday we had this very strong momentum move that breaks this high, right? So this is a sign for me that it's turning bullish, right? Previously it's coming down, now it's turning bullish. Okay. So that itself, with the momentum itself, this two element tells me that it's shifting. Okay, so I mean that's one way, right? It doesn't need to be like following exactly what I do, but just giving you example. Cool. Okay, I think last question in here is, how do you know when emotions are controlling rates rather than logic and strategy? I mean, that's really back to your self-awareness, right? You should know more than anyone whether your trades are emotional or not, right? The idea here is today, if you are taking trades beyond, outside of your trading plan, outside of your strategy, then obviously that's an emotional trade, right? Okay. Uh, yeah, I mean that one is something you probably know best, right? And you need to be obviously honest with yourself on that. Okay. Good. Okay. So yeah, I hope today has been helpful. Okay. Some of you here says very, very helpful, things like that. Good to know. Okay, good. Right here, basically, I've been putting it up for some time. Is basically the summary of what we covered today. Uh yeah, and just want to say, do a closing statement and say that, strategy is important, but that's where a lot of traders focus on, techniques, analysis, strategies. But beyond that, this podcast today are actually things that um whether you're gonna be consistent and sustainable in the market versus another trader that may not, even if both traders are trading the same strategy, right? So what makes the difference is really all this intangible stuff that is beyond the strategy itself. Okay. So yep, I hope today's session has been helpful. I'll very quickly pass the time to the team to do the closing. Okay, and hope that you guys actually benefited from today's session.
Awesome. So thank you so much, Kar Yong. And to all of you, that concludes our webinar today. And hopefully we have addressed all your thoughts, all your questions, all your concerns as well. But if you have any other questions in the future, you can always reach out to our live chat team through the Bull Prime website at www.bullprime.com. And to all of you who have signed up and attended today's session, you are about to receive a $15 bonus in your trading account within 24 hours. And once again, thank you. Remember to trade smart, trade Bull Prime, and enjoy your weekend. Thank you.